Bloomberg Audio Studios.
Podcasts, radio, news.
This is the Bloomberg Surveillance Podcast. I'm Jon Ferro, along with Lisa Abramowicz and Anne-Marie Hordern. Join us each day for insight from the best in markets, economics and geopolitics. From our global headquarters in New York City, we are live on Bloomberg Television weekday mornings from 6 to 9 a.m. Eastern. Subscribe to the podcast on Apple, Spotify or anywhere else you listen. And as always, on the Bloomberg Terminal and the Bloomberg Business app. Mohamed, El-Erian of Queen's College, Cambridge. Mohamed, good morning to you. It's good to see you.
Good morning, John. Thanks for having me.
Is it all just a bunch of happy talk? All these good things, good vibes about the US economy?
It's happy talk justified on where we've been, but it is dangerous looking forward.
Jamie Dimon sounded like you earlier this week, speaking to Francine Lacqua. I'm not sure if you've seen the conversation. I'll bring you one of the quotes. There's a lot of inflationary forces in front of us, he said. He gave us a list of reasons that you've given us before. The green economy, remilitarization, infrastructure spending, trade disputes, large fiscal deficits. What exactly is this Federal Reserve fighting?
So, first of all, Jamie and I have been on the same wavelength for a while, so thank you for saying that. Look, this is a reactive Fed. This is a data-dependent Fed. So when Jamie and others list the things going forward that are inflationary in nature, that's not something that the Fed talks about. The Fed talks about the latest set of data. And that is, we're going to continue having a reactive Fed because this is a Fed that lost self-confidence back in 2021 when they tried to be strategic and got the call horribly wrong. So what is the safest thing to do is to become data dependent, and that's where the Fed is.
So no strategic outcome, which is what you've talked about repeatedly, and hypersensitive from data point to data point. Ultimately, what does that mean for financial markets? Lots of volatility but trending higher?
Yes, as long as the whiff, I want to stress, it's a whiff of stagflation, doesn't turn into something stronger.
Stagflationary winds, I think, is what you've called them.
Correct. And that's what you have to keep an eye on, is that we don't want that to become something much stronger.
When you say the Fed is data dependent, how dangerous is that when you have revisions like we had this week with the PPI report?
No, it's very dangerous. It's dangerous first because the data is very noisy, both in terms of month to month, but also in terms of revisions. It's also dangerous because the data is backward looking and their tools act with a lag. So this is not where you want to be. And there are articles, there was another one yesterday, that they are trying to encourage the Fed to be more self-confident and look forward and be less data dependent.
When you talk about potentially stagflationary winds, I recently caught up with the former World Bank head, David Malpass. He's been talking about this for a while. Where exactly would you see that showing up if we were to see stagflation? Where exactly would you be looking?
So, Anne-Marie, you talked about it earlier. Listen to the corporate calls. They're telling you that certain segments of the consumer base are already having problems. Listen to the previous interview, which was a very bullish interview about the economy, but there was an admission right there that if anything happens to the labor market, we have no buffers. We have no spare tires, that balance sheets have really deteriorated. John mentioned what happened in the interview, where it's every segment of the population that's now running much higher balances. So we no longer have pandemic savings, we have higher balances on credit cards, we have higher interest rates, so we're totally dependent on wage income. And if anything happens to the labor market, which I hope it doesn't, but if anything happens, then we are going to slow down really quickly.
But Mohamed, this is the thing. I mean, you've hit the nail on the head, is that the data is uneven. We're seeing a divergence between different types of consumers, except perhaps when it comes to some of the credit card data. The data was built a long time ago when we didn't have that type of divergence. It was trying to capture an American economy that was a monolith. Do we have the right tools to even evaluate the American economy at this point?
So, Danny, that's a really important point, and also it explains Anne-Marie's point as to why the person in the street doesn't feel as good as the macro data suggests. Look, during the pandemic, we had this wonderful moment where we realized that our existing databases were too partial, and we moved quickly to high-frequency data. And suddenly we were living in this world where we were, as economists, we were much more focused on let's get the best data, let's get high-frequency data. When we got out of the pandemic, we went back to the old world, and we don't use the high-frequency data enough. Now, there are efforts being made at the NBER and elsewhere to try and incorporate that high-frequency data. The big problem that we don't talk about is that the providers of those high-frequency data, who used to provide it free, are now charging money. So when you charge money, guess what happens? The access to that data goes down. So this is an issue that's being discussed in the economic profession.
Do you see mistakes being made this time around?
being the reverse of the mistakes made last time around, coming out of the great financial crisis. We were all waiting for the economy to go back to what it used to look like, and it never did. And it took a while for everyone to start agreeing with Larry Summers, and they eventually did. And coming out of the pandemic, ultimately, we're waiting for the economy to go back to what it used to look like, and maybe it never will. And we heard this from Bridgewater this week at the Qatar Economic Forum, powered by Bloomberg, when Bridgewater's Nir Bardia said, don't use the playbook for the last 10 to 15 years for the next 10 to 15 years. So let's maybe park next month's data, next quarter's data. What are you looking at right now for the next decade or so? What are you expecting?
So first of all, I think the big mistake coming out of the global financial crisis was to assume the shock was cyclical, if you like a V, and not to realize it was secular. Thus PIMCO's new normal, which came early on in 2009. I think the big issue right now is that we as a profession and we as a market are too influenced by what happened after the global financial crisis. We believe somehow still in the back of our mind that low interest rates, very low interest rates, are the norm, not the exception. We believe that inflation is not an issue. So look what has happened to the Fed. The Fed pivoted on the basis of data. It was the opposite of the pivot they did in December when they pivoted on basis. Now they have to do a U-turn. As they're doing the U-turn and say higher for longer, the market is going the other way. So you saw what happened to the 2-year, you saw what happened to the 10-year. And then there are two really problematic issues that we don't talk enough. How sensitive are the stubborn components of inflation to interest rates? They're not very sensitive. That's problem number one. Problem number two, what indications are we getting of the economy? It's slowly weakening. So it raises the issue that once again, the Fed is going to have to pivot, this time not on the basis of the inflation numbers, but on the basis of the real economy numbers. It will pivot yet again. And then there's the big issue that I know no one wants to discuss.
Go on.
And I insist, and I understand that fully, is the inflation target the right target? We all talk about wanting to go back to 2%. Every single quote you had this morning assumes that 2% is the right inflation target. 2% is totally arbitrary. But I understand why no one wants to talk about this. But we should all realize that if we are pursuing the wrong inflation target, the risk of a mistake, and that mistake would mean sacrificing growth unnecessarily, the risk of that mistake is high, especially when the low-income people are most at risk.
I know how much criticism you get every time you bring this up, because you've been bringing it up with me for the best part of 12 months, maybe longer now. If we go back to the Jackson Hole speech from Chairman Powell in August of 22, when he talked about pain being required to get inflation under control, then the experience of the last 12 months where we all got seduced by this idea that maybe we don't need pain whatsoever to get inflation back under control. Are you saying that the pain that's required to go from 3 to 2 just is not worth the squeeze?
Correct. I'm saying that if you were to establish an inflation target today based on the secular issues, and let's talk about it, the domestic paradigm is changing. We're no longer in this Washington consensus of deregulation, liberalization, fiscal prudence. We are in a world of industrial policy, government intervention, and fiscal irresponsibility. Let's talk about the international. We're no longer talking about ever closer globalization. We're talking about fragmentation. Then look at the transitions we have. We have major transitions going on, not just generative AI, life sciences, and sustainable energy. You have things happening in healthcare. You have things happening in defense. You have things happening in food security. If you put all that together, it is a different inflation environment. It's a world that's subject to higher inflation, and we've come from a world that was subject to lower inflation.
But if the world still has that recency bias in their mind, that we're going to go back to 2%, there are entire industries that are extending and pretending and hoping we're getting back there. I think of the private capital world, for example. So if you have financial markets that have engineered themselves to be used to a low inflation world, that have been used to rates getting somewhere to 2%, what happens? What happens if we don't get there?
Danny, you're absolutely right. And yesterday, the whole news yesterday was about commercial real estate, was about Slough, right? They've recognized, and more importantly, investors have recognized that there's a valuation issue ahead. And that's also an issue, is you have slower moving segments that refinance in a very discrete fashion that we're going to have to deal with. You're absolutely right.
Stocks on pause with markets at a crossroad. Katy Kaminski of AlphaSimplex writing this. The market seems to be polarised between two views. Bullish view on equities and growth versus worry over sticky inflation and higher for longer. As a result, trend signals with long equities, with short fixed income, long dollar and long commodities. Katy joins us now for more. Katy, let's just sort of break it down into its individual parts and start with the bond market. Last time we spoke, you said there were more reasons to be short. What's happened in between conversations?
Well, I mean, we've really seen a pullback this month based on inflation coming not as hot as people might have been worried about. And so I think we're getting closer to a point where we might actually see cuts this year. We know the Fed wants to cut. I think this trend, it's been very confusing. Look at bonds. They're trading a lot more like equities. Vol is high, and on the year, bonds are down. So I think the really big question is going to be who wins? Is it the inflation narrative staying longer? Or is it that equities are right, that we can sort of smooth into rate cuts this year? So far, signals are still short in fixed income because look at the long-term trend. It's still there despite the recent pullback.
So if you can help us go through what you're positioned for right now, bonds versus commodities, and let's throw foreign exchange in there too.
So I'd say right now what you see is that the short bond signals really tell you higher for longer. You're also seeing in the commodity markets, and I think that's the thing that we're watching the most, massive moves in commodities this year. Commodity indices are up over 10%. Take a look at the precious metals. Copper in particular has been up tremendously lately. So these are signs that are not talking about the consumer, but really talking about prices of raw goods. And I think you're still seeing that mixed picture where cross-asset themes suggest higher for longer and concern that it's going to take longer to get over the inflation issue and get inflation down than people would like. It's very fascinating as well that the ECB might cut first. In some sense, that'll be a good proof point to see what happens when when a large economy like the ECB starts cutting.
Let's go there then, Katy. What are you looking for? What are the risks and potential takeaways from the reaction of the bond market to the ECB that you can apply to the U.S.?
Well, if you look at inflation data, it looks steadier in the Eurozone. And the Eurozone has definitely seen more restrictive effects of policy. And thus they're, like your previous guest said, more positioned to kind of have to deal with that issue. The U.S. is more confusing because the data is just much more mixed. So it'll be interesting to see how the market actually reacts. And if indeed we do see a pop-up in inflation, which is sort of your upside risk in the Eurozone, then it's really going to get interesting this summer. So there's really a lot of things that could cause markets to be very trendy, but also very volatile as we try and navigate this pivot.
And that's exactly what we've had, Katy. We've had huge amounts of volatility. You and the team have done the research that bond volatility is something like 50% above its pre-2022 level. That's great for you and the team at AlphaSimplex who can trade in and out of bonds. What about the rest of investors, Katy, that view bonds as something that you buy and you hold? How does it change things when you see this market that's known for being staid, being more volatile in some cases, more than equities and more than FX?
This is a very good point, and I think it's the biggest and most important thing for investors to take home. When you're thinking about bonds as a risk-off asset, as a risk-free safe haven asset, that is not the case in an environment when inflation comes into play. In fact, bond stock correlation has been positive for quite some time, and bond volatility is higher. Like I said, bonds trade a little bit more like equities. This means that investors need to look around and find things that actually like inflation and like this type of environment that actually complement their portfolios, because you just don't have that flight to safety asset in the traditional sense. When we think about stocks going down, we think about bonds being there as our ballast. And in fact, when we're dealing with inflation, that ballast is just not as good.
So are there strategies then, Katy, that going forward should cease to exist, that investors shouldn't be looking into anymore? I'm thinking of the risk parity, the 60-40s. We've talked about the death of them for a long time. It hasn't happened. Is this it?
No, I would say they still are there as an important tool in your portfolio, but your portfolio isn't complete. You need to start thinking about what assets will benefit from changes in inflation, things like commodity exposure, things like assets that have, real estate, for example. So really sort of diversifying your portfolio to be aware of the potential vulnerabilities of fixed cash flows in an inflation environment.
Katy, I think you said it at the start of the conversation, the risk mitigation characteristics required depends on what you think the dominant risk actually is. And when we go through your quote again, the market seems to be polarized between two views, a bullish view on equities and growth versus over sticky inflation and higher for longer. What are the two ballasts you need in the portfolio to account for some of the risks out there, given how polarized they are at the moment?
This is a good point because usually we just worry about recession. We worry about equities going down. Right now, we have to worry about the impact of inflation. And that's precisely the risk that you saw manifest itself in April. I know we've already forgotten about it after this week's big rally, but the truth is the key risk that we're facing is more that inflation is really causing stress in our system, and thus a risk for investors is very different from a pre-COVID type of risk, where we're thinking about how inflation will affect all of the assets that we hold and will cause divergence across both monetary policy and also across regions geographically.
And this takes us to the commodity market, which you've already referenced. It's a broad place, a broad space. Katy, what would you pick out in the commodity market right now? Is it base metals, precious metals, fossil fuels? Where do you want to be?
So far, the things that have really been working this year, take a look at copper, cocoa, some of these big commodities that have moved. I highlighted that the index is up over 11%, but you're also seeing, I think, the most interesting trend to start watching. The one sector that has been disinflationary this year to date has been agriculturals. And you've actually seen things like corn, wheat, soy, many of the agricultural products actually starting to pivot for the first time, just as we're talking about cuts. So that to me is very interesting. Watch energy. It's continued to move up as well. So all of these things are definitely putting a headwind against this inflation narrative, and they're going to make this more tricky this summer.
Katy, one metal you didn't mention is gold. Continues to rise, but there's a lot of different reasons why some strategists say it will continue on this trajectory. What do you make of gold's ascent?
So gold is often seen as a great safe haven investment for inflation. And so what was interesting to me is just to watch the tremendous acceleration in gold around the time where people started to get reconcerned about inflation, particularly April. But what's even more interesting is that it's continued into May. So it seems in some sense that people are thinking about gold as their safe haven asset instead of bonds, given the volatility and the risk-off properties dissipating in those assets. So I think gold is something to watch as a barometer of how people feel about the realities of inflation.
Katy, thank you. Katy Kaminski there of AlphaSimplex. Fed officials maintaining the central bank should hold rates higher for longer while the ECB gears up to begin cutting next month. Gilles Moec of AXA Group saying this: "We are concerned about the risk of an intellectual contagion from the debates in the US. The risks are asymmetric across the Atlantic. Reading Europe with American lenses could lead to costly policy mistakes." Gilles joins us now for more. Gilles, wonderful perspective, sir. Do you see that as a very real and evident risk right now in Europe?
Yeah, as usual, the US market is the dominant market of the world, and there might be a sense in Europe that diverging too much from what the Fed is about to do or about not to do would actually trigger a further weakening of our currency, which in turn would trigger more imported inflation and would make our own progress towards our inflation target harder to hit. So there is this contagion channel, which is pretty traditional in policymaking in Europe. But what I would venture is that, first of all, the inflation story in Europe is clearer than in the US. It's heading down, I think, in a more obvious manner than the US. And second, when we still have issues with our inflationary process in Europe, it has not it doesn't have anything to do with imported inflation. It's usually about domestic forces, services inflation in particular. So even if we had a further depreciation of the euro in case of a growing divergence with the Fed, I don't think it would massively change the picture for our inflation forecast.
So you think they should de-emphasize the importance of the FX channel? Is that right?
Yes, and that was something that was very obvious in the latest minutes of the ECB Governing Council. They clearly spent quite a bit of time talking about inflation in the US, talking about what it meant for the Fed, and again, it's obvious the Fed is the biggest, the most important central bank of the world. You cannot completely ignore it. But our inflation story on this side of the pond is very, very different.
Danny mentioned what we heard from Isabel Schnabel in the Japanese newspaper Nikkei, saying based on current data, a rate cut in July does not seem warranted. Gilles, based on what you just said, what's your reaction to that communication from a key executive board member?
I think what's interesting on the positive side, if you want, or on the dovish side, since it's usually my tribe, is that they're already talking about the next cut. The June cut seems to be completely in the bag, which in a way you could find reassuring coming from someone like Isabel Schnabel, who can be a hawk. But you can see how the conversation is already focusing on, well, we have to be very careful. We have to be very, very patient, very slow in our own process. And the risk there is that you end up with actually undershooting your own inflation target. And it's not a theoretical issue. The Central Bank of Sweden has just had to cut rates without waiting for the ECB or without waiting for the Fed. And when you look at their own inflation forecast, they already have inflation below 2%. In the latest forecast we've had from the Bank of England, same thing for 2026. They're clearly concerned that inflation could fall below 2%. So I understand we need to be prudent. And as far as I know, no one is calling for a rate cut in July. I'm not calling for a rate cut in July. I think September would be fine after June. But it's a sign of the ongoing tension within the Governing Council. The debate has shifted from should we cut or not, that's fine, to how quickly. And the fact that Schnabel is already warning against a July cut, I think, betrays this, reflects this internal tension at the Governing Council.
Gilles, what I can't understand is what's even the point then of cutting in June? What difference does it make if you cut in June and then you pause for a while? Let's say you go in September. We're talking about 25 basis points here. We're talking about only a few months apart. Why is this such a vigorous debate?
I think it's a vigorous debate because the inflection point in your stance is always the most important one. Because obviously, the ECB has been hiking for a while, has continued hiking later than the Fed. The Fed stopped 3 months before the ECB. So there's a lot of symbolic and policy focus around the inflection point. When do you start cutting? Because everyone knows that once you started cutting, well, it's usually the beginning of a trajectory, and it may come in July, it may come in September, it doesn't really matter. You are on a downward trend. So the biggest fight, if you want, was on should we cut at all? That's now completely in the bag. Now we're talking about the trajectory, and I think it's actually less problematic if the ECB waits for 2 or 3 months after having provided this first cut, because the entire market will know, okay, it may take a bit of time, but the direction of travel is super clear.
Gilles, I get that, but I mean, is it the same this time around? I mean, this isn't a classic cutting cycle as most of us know it. This isn't a recession that the ECB needs to get somewhere in a hurry. As you say, they can take their time. This is more of a mid-cycle tweak. So can we really look at it the same way, that this is as big of an inflection point as it usually is when an ECB, when a central bank starts to cut?
I think it really still matters because we've got this issue of potential divergence with the Fed. There is in the market a very strongly held belief that usually it's the Fed which sets the tone. So I think that from a symbolic and more than symbolic from a policy point of view, that the ECB would in June take the risk of diverging for the Fed, making its decision for itself without necessarily waiting for what happens across the Atlantic. I think it's a very, very strong signal that indeed monetary policy in Europe is decided based on the inflationary process in Europe. We cannot entirely ignore whatever comes from the exchange rate channel, but 90% of our decision-making should be based on domestic development. So I agree with you. There is no recession we need to deal with at this moment. But I think the ECB needs to send this very clear message to the rest of the world, really, and to public opinion in Europe. We make our decisions based on what is good for Europe. And the fact that the Fed is facing currently difficulties with a less clear disinflationary process should not stop the ECB from making the right decisions.
Gilles, enjoyed talking about this. As always, sir, it's great to catch up. Gilles Moec there of AXA.
This is the Bloomberg Surveillance Podcast, bringing you the best in markets, economics and geopolitics. You can watch the show live on Bloomberg TV weekday mornings from 6 a.m. to 9 a.m. Eastern. Subscribe to the podcast on Apple, Spotify or anywhere else you listen. And as always, on the Bloomberg Terminal and the Bloomberg Business app.